Good morning, everyone. Welcome to this update for global stocks and commodities for the 23rd of June. What an extraordinary situation we've got where the S&P has now set new all-time highs, and that was only just a few weeks after, I guess, most analysts and many millions of investors around the world were wringing their hands that we would probably get lower levels. It's really just quite extraordinary how much central banks still control where the market goes. And it's pretty clear over the last decade that when monetary conditions are being eased, or there is a lot of stimulus being put into the system, that the stock market does well. And when it starts to reverse and go the other way, then the stock market doesn't do so well. It's really not much more complicated than that. A lot of people are looking for reasons for the market to go down, and have been for many, many years. But you've just got to stay focused on what is. So that's what we're going to have a look at today. It's the ultimate driver of market direction. But if you look at what gold is doing, it's certainly suggesting strongly that there are still many people that are looking to find an alternative to just stocks. And of course, gold does offer some degree of safe haven status. It's been ignored for a lot of the last couple of decades, but certainly looking a lot more promising now. There'll be the normal stock and commodity trend update. And in Portfolio Analyst last week, I started the process proper of selecting 10 baggers. We're setting up a portfolio. There's already 3 or 4 candidates in that portfolio. Look, most importantly, the monitoring process that goes with it and the management process that goes with it, because hardly anyone on the planet can just buy a stock that's going to go up over 3 to 5 years by tenfold and not have various periods where they're going to be tempted to sell out. Most people probably do sell out, and they end up missing most of the move. So the ongoing monitoring process is just as important as making the selection in the first place. So that process now is up and running. American stocks, the S&P ended up gaining 2.2% for the week, which is pretty robust, considering that it was already at reasonably elevated levels. And just amazing, a new high already. I certainly didn't expect it, and I didn't hear anyone calling for it. And I read from many different sources, and no one was expecting a new high in the S&P. I think even the most bullish of people were expecting the market probably just to go sideways. Now, on top of that, we've also seen the junk bonds, and I've been talking about bonds now on and off over the last few months, and the importance of monitoring those. Junk bonds have now rebounded. Not only have they fallen apart like the indications were starting to appear, but they've actually just set new highs. So it's quite an extraordinary turn of events. And we've also got the long-term curve in bond yields is now starting to steepen. You've read and heard, I'm sure, for some time about yield curve inversion, which is an indicator of a recession. Well, we've now got the long end of the bond yield curve is actually steepening, which in layman's terms means that economic growth is accelerating. That's what it means. So that's sort of defying again the people that wanted to take a very bearish view on financial markets. The other thing that of note in America too is that with the Fed's rhetoric through the week around the possibility of rate cuts, the US dollar basically crashed down through trendline support. So that, I think, is a very key event in the week, because it's been in an uptrend now for some time. And the market is, this is not what the Fed is saying yet, but the market is pricing in 2 or possibly even 3 rate cuts in the second half of this year before Christmas. And again, that was unthinkable just a few months ago for the US market, which was pretty much the only economy that was basically looking at higher interest rates. Now, as a consequence of all that, the 10-year yield fell below 2%. during the week, ended up finishing just back above it at 2.05. But again, just think back to not even this time last year, less than 12 months ago, the yield was 3.25 and seemingly headed almost without question to 4%. That was consensus thinking. So again, another demonstration that consensus thinking is often wrong, and when everybody is on one side of the boat, then it certainly pays to at least have a look at the case for the other side, and that's certainly what's happened in the bond market. All right, let's look at some charts. Okay, so we'll start with the S&P first of all, and I've got it on a big picture view. So this is the monthly chart. In the middle here is the lows after the GFC in 2009, and you can see that it was relatively stable. Now, okay, we're now at a much higher index level than we were back here, which tends to amplify the action, but I think you can get the picture. We had a long period of stability here from 2011 until 2015, so nearly 4 years, where the market just went up and up and up. We then went sideways for a period during 2016, but then, as you can see, from around about February, March of last year, the market has become more volatile. Now, because we are at a higher index value, that is not as dramatic when you compare it to this area down here. But nevertheless, the volatility has picked up. That's for sure. But you can see we had this sharp move down in December, which was all about the perception that the Fed would just keep. In fact, more than perception, Jeremy Powell was on record as saying that there was still a long way to go in terms of their monetary tightening. And the market hated that, as you can see. So we got a very bad sell-off in October, and then very much so in December. And then it all just abruptly turned around when they changed their language. So, if you want a more graphic demonstration of the link between easy money and the stock market, then that's it right there. There's the S&P 500 on a daily chart. So you can see we managed to have a little peep over the top on, we certainly closed slightly above it on Thursday, went on with it on Friday, but then closed close to the low of the session. Now, it was all pretty undramatic stuff, so we might pull back in the short term, just pull back into this range now that, maybe the technical people have had their day. They've had a little look over the top. We might get a little bit of easing in the short term. We might pull back possibly 100 points on the S&P, but then again, it might just keep going on from here. It's really impossible to tell, so I'm not going to burn up too much energy thinking about it. Just while I'm here, this is the Shanghai index. So we've certainly seen some improvement in the Shanghai index, and I think that's certainly correlated to two things. There's been obviously a backing off in Hong Kong of that very controversial legislation, which has helped, but also the suggestion that Trump and President Xi would reach some sort of agreement, or at least be talking at the G20 meeting. So we saw a bit of an improvement there. If we look at, just to show you the breadth of the American market, so this is the Russell 2000. So this rise in the S&P is not just about a handful of big stocks. This is pretty broad. Now, we're well off the highs that we saw in September last year, so the small caps are weaker. But if you look at the most recent period, it's pretty similar to the others. So certainly the breadth in the market is still there. This is not an index that's just being led by the big stocks. Now, the next chart I want to take a look at is the US dollar. So there's the breakdown. We had a really nice, steady uptrend going, and we've had, since the Fed announcement, there was the Fed announcement or Fed meeting there on the Wednesday, and you can see 3 concerted days of selling. Now, on the other side of the coin, the Australian dollar, you would expect would have been a really big beneficiary of that, and it has lifted a little bit, but it hasn't lifted by anywhere near the amount that the US dollar has gone down. And that, I think, largely reflects where our economy is at, and also where some of the commodity prices are as well. They're not exactly that buoyant at the moment. Now, the other very telling chart. This is the junk bond HYG ETF, and you can see it's basically set a new all-time high. This was the very, very sharp sell-off that we saw in the panic in December. So that's what the junk bond market does when things get really unstable. It fell from around 85, 86, and we fell down into the 70s, which is quite a lot. We then got another corrective period just recently during May, when the market was expecting that that more risky credit was going to be in trouble because of the economy. But look at the rise that we've had. Basically, the lows were on the 3rd of June, and ever since then, it's gone straight up and set new all-time highs. So there's not really any apparent worries in the bond market once again, which frankly I find amazing, because there's a lot of very low quality credit in America that is eventually eventually that's going to break. But at the moment, the market is not pricing that in, and that's the important thing, that we go with what is. All right, let's move now to the Australian market. The Aussie dollar managed to work its way up a little bit. 69.3 is where we finished. But look, all currencies are responding to rate cuts. So it would appear that the US is cutting rates. So the US dollar's falling. The Australian, the RBA is almost certainly going to cut rates once or twice more. So there's rates being cut all over the place. So that is just a bit of a leapfrog situation, where it's currencies in the short term are going to go up or down on a relative basis to the US dollar. But if you step back from that, there's got to be other factors that are driving it. And for the Australian dollar, the deciding factor is going to be commodity prices and how China's going, and the perceptions over the US and China dispute. So that'll be the driver of the Aussie dollar. But certainly it's very good news for anyone that has money in America denominated in US dollars, because not only has the stock market gone up, but the value from an Australian dollar point of view has gone up as well. Our index ended up gaining 97 points for the week, and it's not far off the all-time highs back in 2007. It's taken us a long time. That's nearly 12 years. So we're certainly lagging the rest of the world by a long, long way. But we're back there. And again, that's something that I didn't expect to see. The outperformers, from my perspective, as the members of my various services would know, growth stocks that have got a global presence just had an outstanding week last week, and they just continue the powerful gains that we've had, and we've got several that are in our portfolios that have doubled and even tripled from where we originally got in, and in some cases not that long ago. So it's been an extremely good period for those Australian growth stocks. Okay, there's the ASX 200. You can see we set, now this is on a weekly chart. So you can see that we managed to get above the August highs of last year, pan back, and there's our all-time highs set in November of 2007, and we're very, very close to getting back there at the moment. So that's the Australian index situation. Now looking at gold. Okay, there's gold on a weekly chart. You can see here was the key line in the sand. So this is a chart that I haven't touched now for probably several years. I haven't changed the format of this. We were going sideways. We had an uptrend. We did break out of that uptrend in August, so things looked a bit shaky for gold, but it's managed to pick up again, and now we've finally got this breakout above 1380, and it's I think the overwhelming odds now are that gold continues on from here. Now that's a weekly chart, so you've got to be patient with this. It may not just sprint away from here. I have no way of knowing, but there is gold on a daily chart. So you can see it's very overbought on the RSI. So, and it's been an amazing move. So wouldn't be at all surprised to see some retracement of that gain. Now we've got another level of resistance. I guess the next one really comes in up here. The next one of significance comes in around 1550. So that's another $150 an ounce. But look, the key thing with, as we'll see for Australian gold stocks, is that the Australian dollar gold price is now up to 2020. And that's gone up $200 an ounce just in the last couple of months. So no wonder the Australian gold stocks are doing well. But look, GDX is also doing well also. So that's a hugely positive sign now. Anyone that's been watching these videos for any period of time know that it's much, much preferable to see the commodity prices leading the underlying commodity, whether it's gold or oil or copper, whatever it might be. And that hasn't really been the case of late. Gold stocks have perhaps only led for a couple of days, and then they've broken down again. So they haven't really been able to sustain leadership, but we're now seeing that. So we'll take a look at GDX because it's broken downtrend resistance also, and it's run up to another key resistance level, and once above that, I think you really see international gold stocks really take off. But it's the local goldies that have done tremendously well. Okay, so let's just look at GDX. So there's the inclined downward trend line that had been keeping a cap on GDX, and again, this is a weekly chart. And I wrote this certainly more than a year ago, maybe even 2 years ago, what we needed to see to demonstrate that we were back into a bull market for gold stocks. So I'll just run through the points quickly. So we needed to see a run up to resistance on rising volume. Well, that's what we're now seeing. The volume, as you can see here, has pretty much doubled in the last 3 or 4 weeks. So we've broken one resistance level. We've run up to another resistance level. The second thing was that we needed to see the candle range expanding. Well, we're certainly seeing that. You can see these candles to the upside. We haven't seen candles of that dimension. You've really got to go back maybe a little bit here in December 2016, but you've really got to go back to February of 2016, which is when we had the last big spike, and GDX moved from 14 to 31. So it more than doubled. That was the last time we saw candle formations like this. So that's very promising. You can see that we're also down the bottom here, we're now outperforming the S&P as well. So that is going to draw more institutional money into the gold stock market, because the institutions can't afford to underperform. Otherwise they get fund redemptions, fund managers get very embarrassing questions asked. So the funds are going to be forced to raise their exposure to this sector. The third thing that I said we needed to see was a shallow pullback from resistance on low volume. If you look at this little period here, you can see the volume was pretty much the lowest that it's been throughout this period. So tick that one. And then the final thing is we need to see a breakout on higher volume. Well, we certainly saw a breakout here, but we need to get through this level. So if we can get through 25.50, and we closed on Friday at 25.21, so we're only about 30 cents away. If we can break above there, then I think it's really on for international gold stocks. But nevertheless, Australian gold stocks have done exceedingly well, and have been all year. Turning to other commodities, copper was up to $2.70 as the US dollar fell, so that's really just pretty much currency effect there, and pretty similarly with West Texas Intermediate crude as well, up to 57.5. So it was mainly on the currency. There's the spot copper chart showing that little bit of a rebound, and also the oil chart. So just to wrap it up, the last couple of months have really demonstrated yet again that if you follow the forecasters, then you're probably not going to do too well, because the forecasters have just been consistently wrong for months and years. And some of the forecasters have been consistently wrong since about 2012. Watch the price action is the only way to go about dealing with this sort of market, because some of the price movements just defy normal logic, but they are what they are. I think one of the reasons that the market is able to sustain this this sort of performance is because, a lot of people are scratching their heads saying, well, we're now into our 11th year of economic expansion. It can't keep continuing. It's got to end because of this, that, and the other. But I think this has been a very slow economic recovery, and so the lack of boom means that any bust that's going to come along that we used to see is taking far, far longer. Now, in a way, that's sort of an indication that central banks are finding it difficult to really get back to the sort of buoyant economic recovery that we would normally see. But I think it's reasonably logical to assume that it's okay for this boom to continue, because it hasn't been a particularly strong one. It's a complete waste of time to try and forecast in this very fluid environment with a president like Donald Trump, capable of doing anything. He thinks he controls the markets, and I suppose to a degree in the short term he is. So it just makes forecasting a bit of a nonsense, really. There's just too many unanswerable questions. What agreement, if any, will the US and China reach? What's going to happen in Europe? What will happen in China? There's just too many questions that nobody on the planet knows the answer to. So there's not a lot of point in trying to think it through and then draw a logical conclusion, because as we've seen over recent months, the market will probably just do something different anyway. Now, portfolio analyst, I'm going to be, to me from here, trade management and portfolio management is absolutely critical. And this week I'm going to be addressing how to go about managing your portfolio when you've got lots and lots of these high growth stocks that have done really well, that have doubled, tripled, or quadrupled, and certainly there's more in the pipeline. How do you deal with that? Because at some point the market will get volatile enough to to do a more significant about face, like we saw in October to December last year. And for many people, it's just sitting through that is not an option. It's just too emotionally draining. So portfolio management is critical. So I'll be covering that this week. There's my contact details for anyone that's not a member of any of the services. And if you haven't tried the Portfolio Analyst $1 trial, then you'll find the details just underneath this video. That's it for this week. Cheers.